Hi guys, Kai Savitsky here again, and today we're finally going to talk about the actual option strategies. We are going to start with a strategy which are usually called the safest one or the strategy with almost no risk. This is a strategy that is considered a good way for a long-term investor to complement their income, especially in a sideways markets. What is strange here is that we are going to short a call here. Going short with an option, especially with a call, is extremely risky thing to do if you do not know what you are doing. But in this case, all risks are covered. Let's start with the basics. How to actually set up the strategy? There are just two very simple steps. You just need to have 100 of the shares of your favorite stock, and you will need to sell a call short here. Now let's go deeper. Why do you need 100 of shares? Because as we were talking in the previous videos, one option contract can cover 100 shares. So it can be different in some cases for some exotic equities or for futures, but for regular shares it is always 100. So you need to own those 100 shares of your favorite stock or ETF or whatever. This is also why the strategy is called covered. When you are shorting the option, you are open to unlimited losses. In theory, stocks can go from $1 to 1,000. And if you are not hedging your short option, you can lose a lot. And if the option strategy is not covered with some kind of stock, with some kind of underlying, then it is called naked. So here we are talking about the covered strategy. Now we need to sell the call option to open the position. And think about how the calls actually work. When you long or when you buy a call, the market maker will owe you the amount of money that is over the option strike. Basically, if shares will go over the strike price, you will be able to buy the stock at the given strike price. So if you had a Tesla option with a 500 strike and shares are currently at 600, now you have a right to buy the Tesla at $500, which is cool, right? But in this case, in this strategy, we are the seller. I hope you understand already what does it mean. And basically it means that we will have to sell the shares at the lower price in case if stock reaches the selected price. Not that cool anymore, right? So where is the catch? Why people use this strategy? Now imagine that you had 100 shares of Apple and it had a really great run. It went from 100 to 130 and now it just goes sideways. Your capital doesn't grow and it just sits there doing nothing. But you do not want to sell those Apple shares for some reason. You also expect that Apple even will not rise in next 30 or 50 days. So you can just sell an option and get some kind of fixed additional income. So if the Apple is at 130 right now and you are sure that it will not go over 150, you can easily sell a call and get some money for it. Basically, you will just profit from the passage of time. You've sold the option and now you just wait for it to expire worthless. If it will happen, you can take your option premium. But technically you will take it from the beginning and right away. And then you will wait until the expiration date and you can sell another one. And you will wait again and again and you will wait more and more and you will earn theta for every slowly passing day. It should be clear now how you will earn money this way. If the market goes just sideways and shares do not reach the strike price, you can just keep your premium. But what can go wrong here? What can happen if the stock price rises too much or falls? There are three different ways now. The first is when the stock just goes down. If it falls just a little bit, you will be hedged by your call option premium. So let's see this closer. If you had 100 shares of Apple purchased at 130 and then you sold the call with a strike at 135, getting 350 in premium for it. Now the total value of your shares is 13,000. If the stock price will fall by 2.5% by the expiration date, you will not even feel it because those 2.5% will be covered by your call option premium. Basically, call expires worthless. You take those 350 of the premium and you do not lose anything holding your shares, which is a pretty good option. The second option is even better. Setup is basically the same. You own those same shares of Apple that you purchased at 130 and you sold the call with a strike at 135 that gave you 350 of the premium. By the time of expiration, the Apple shares have actually increased in price, but they're still lower than 135 or actually equal. Here you get the profit from both. You get the option premium and your shares. This is even better than the first option. On the other hand, what happens if the stock rises or falls by too much? Well, here it depends on your goals. If the stock rises over your strike price, then shares will be taken from you. You'll have to sell the stock at the price of your strike. You will also keep your option premium, so you will not lose here. But just from the experience, it is extremely sad to see your shares to be sold for nothing when the stock jumps by 15% for some reason. It is so difficult to give up those profits that you already saw in your account. And if the stock drops too much, more than you actually received from the option premium, you will still have your option premium to cover some of those losses, but since the premium is fixed, it will help you just with a small part of it. However, if you are an investor and you keep the shares for the long term, it can be also a good opportunity to buy more, especially given the fact that you actually received some profit on the short call which has expired worthless or which you sold for profit. Okay, I guess it is already kind of hard to swallow, so we'll take a pause here. And in the next video, we'll be talking about covered call types, about calculation of the expected returns and break-even points, and of course about some follow-up actions if something goes wrong. Also, please be awesome and subscribe to the channel if you didn't yet. There are lots of new videos planned and some are already on the way, and new likes are really a great source of motivation to continue. Thanks a lot for watching. Be a good boy or girl and do not make any risky trades. See you in the next episode.